Hello and welcome to the Bulletin with UBS on Monocle Radio. Each week, the sharpest minds and freshest thinkers in finance take you beyond the numbers and hype, right to the heart of the big issues of the day. This week, we're looking ahead at the second half of 2024 and more specifically towards November's US presidential election. What's happened in the first half of the year? Well, equity markets have rallied, with the S&P 500 gaining 15% year to date, backed by an AI-driven boost to corporate profit expectations. The gains have come despite US inflation proving more persistent than expected, delays to interest rates, and the 10-year US Treasury yield rising. While the geopolitical situation remains uncertain, volatility has stayed relatively low across asset classes, although gold prices have rallied. And in the second half of the year, well, the US will decide its next president. AI should continue to advance rapidly, and interest rates will likely be cut. Investors will be watching how these events shift expectations for the year ahead. Well, here to look ahead into the second half and to hopefully address some of these questions, we have a panel of the best and brightest from UBS. Let's hear from them now. We start with Kiran Ganesh, Managing Director in the UBS CIO. Kiran, always a delight to talk to you and to get you to cast your well-trained eye ahead over H2 of 24 and, of course, looking to the US election. I don't know, maybe should we start with the presidential election in November? Obviously, lots of volatility, lots of crazy events, and we should caveat this by saying we're speaking on a Friday afternoon. Even just this past weekend, things might have changed and changed significantly. But in broad brushstrokes, give us a couple of thoughts about how canny investors can prepare for the election. You know, this is the time when people start to talk about what will the next administration mean for markets, for example. Give us a few overviews.
Yeah, so it is looking more likely at this stage that President or former President Trump will win re-election as a result of this vote. And I think that investors are starting to focus in on three big areas, really. So one is what happens with taxes and regulation. Two is what happens with trade and tariffs. And three, what happens with the federal deficit. And what makes that a bit complicated for investors is some of those point in different directions. So broadly, we think that under a Trump administration, taxes would come down, or at least they wouldn't go up, and deregulation would be on the agenda. So that should be a relatively good thing for stocks, and particularly for things like financials, which could benefit from deregulation. But on the other hand, some of the recent commentary coming out of the Republican convention suggests that they are ready to take a more aggressive stance on tariffs, particularly on China, also looking at restricting trade in key technology components to China, but also imposing potentially universal tariffs on all imports into the US. Now, clearly, that's a much more negative thing for markets. It could contribute to higher inflation. It could mean that the Fed is forced to keep interest rates higher for longer. So we think that in that context, it does make sense for investors to think about, how can they hedge or diversify portfolios, potentially using things like gold, the Swiss franc, which could benefit from a more risk-off type of scenario, and also managing exposures to currencies like the Chinese yuan, which could be particularly threatened if there were to be large tariffs on China. And then finally, the deficit, as I mentioned, there is talk about tax cuts. There's not a lot of talk about spending cuts. And that could lead investors in treasury markets to fear that you could see funding challenges for the US government. There will always be some demand for treasuries, but that can be limited. And if the supply is too high, then you can see, of course, prices fall and yields rising. So, taking all of that together, it does make some sense for investors to look at how to hedge portfolios against potential risks. But the final thing I would caveat with is to say that it's important not to make huge portfolio swings based on election predictions. It's looking more likely that Trump will win, but it's not a certainty. And we've experienced certainties in politics before that haven't materialized. So I think that's something to bear in mind. The congressional race is much closer. So it is looking more likely than not that the Democrats will win the House. So that could also affect the degrees of freedom for a future president. And finally, it's important to remember that this isn't the only thing that matters for markets. In the long term, economic growth, technological development, what happens with interest rates, inflation, all of these things tend to be more important. So making big swings around based on a certain candidate winning or not, also just doesn't make sense in general. So, we're advising clients to take some action to hedge portfolios, to diversify portfolios, but not to make very large swings or make very big decisions based on a forecast outcome for the election.
Very sage advice as always, and it's instructive actually if we dive into the outlook, for example, that you and your colleagues throughout UBS put together. It's characterised as this idea of decision time, but explicitly not just because the US electorate is going to the ballot box, but decision time, you already mentioned, for central banks, for investors more broadly. And there are crucial areas to navigate. You've touched upon a few, and indeed we'll dig in a bit more detail into some of them with your colleagues, whether that's in FX and commodities or on the equity side. It is interesting, this sort of trifecta, Kiran, of the advances in technology, AI in particular, political changes, but also interest rates. I mean, there are so many things we could talk about, but those three, it feels like if there is a decision time, it's almost at least equal parts of each of those three, right?
Yes, exactly. And while the election certainly introduces concern and some uncertainty into the decision-making process, if we look at the other two areas you mentioned of interest rates and what's happening with technology, then we have actually quite a constructive backdrop for markets. Inflation has been falling. It was actually negative month over month in the US in June, and it's now looking very likely that the Fed will be able to cut interest rates in September. We think the Bank of England will cut rates in August. The European Central Bank will cut rates again in September. So the backdrop for investors, with rates falling, growth still decent, and inflation falling as well, that should be a good thing for investors both in bond and equity markets. And then on the technology side, you've got still very large investment going into AI capabilities. That's generating really large earnings for some of the providers of semiconductors and cloud services. So that's a big trend that's been driving markets higher. So what we're saying to investors, again, is think about hedging around the US election, but generally this is a favorable market to be invested in, and it's important to be still exposed to potential upside for stocks. And we think bonds can do well in this environment as well.
Kiran Ganesh. Well, next up, let's turn to Dominic, Schnider, Head of Commodities and Forex in the UBS CIO, for more, as we mentioned, on the FX and commodities picture. Dominic, welcome back to the show. If we're talking about Forex and commodities, how would you characterise the opportunity? And do we need to look at everything in a context of, fading strength of a US dollar going forward? Give us a quick overview.
No, I think let's start with the FX complex. I think you have a quite interesting story here. You have like two forces, you could argue, like a rubber band pushing in opposite direction. And maybe you shouldn't be surprised as in the short term, we haven't seen actually that much change in FX markets. So what is the first rubber band I'm talking about? Well, it is the reality that the US data is actually slowing. And I think that's what you have seen in the market being priced. The market looking for 2 cuts down the road until year end, and probably much more to come than in 2025. We think that element is dollar negative and likely to present itself into the election. So that's one rubber band that calls for dollar weakness. The other one, obviously, Trump has the potential to actually be dollar positive. Two angles here, obviously. It's all about the tariffs on imports and what does it do to global trade, the element to bring a little bit uncertainty to the market, which is good for dollar and which is on the other side, I would say, negative for pro-growth currencies. On the other side, we also need to think about he wants to be a little bit more fiscally supportive, even though you can ask yourself, how much is that still possible, given that we have already been spending quite a fair bit and deficits are huge. So it's a little bit of a question mark that obviously how much can really the Fed cut in an environment we want to run a high-pressured US economy. So two things. That's why we haven't seen that much, I would say, trend in FX market. If you ask me where to put the focus, I would still think the dollar's a sell and rally. So if we get elements of strength, we want to sell basically the dollar, because longer term, this macro picture I told you before, high valuation, fiscal deficit, that still calls for me for a weaker dollar longer term. The other part to think about is if you want to look for alternatives, I think the Swissy is still something to think about. I mean, it tends to benefit from uncertainty. It basically also has a situation where the SMB is cutting rates, but probably for the last time, while everybody else is going to lower rates. the SMB is done. So we're going to see a narrowing in rate differentials, and that should support the Swissie as well. And if we think about these more longer term element, the Swiss balances are actually looking quite fine. So clearly something to hold, and maybe something you shouldn't hold in the short term given the weak data is probably the CNY. I think hedging CNY exposure is highly advised, also considering the US political risk that we have, which could bring additional downside to the CNY. We're looking at CNY heading towards 7.45.
Yeah, super interesting. And we'll cross and talk about commodities in just a second. But just on Trump, and you've sort of alluded to this already, Dominic, if we think back, for example, to his previous term, Trump was talking about supporting the gold standard policy, wasn't it? And nothing actually happened. And I guess it is always instructive, whatever area actually we look at, to remember that the political rhetoric doesn't often, indeed quite often never, is actually reflected in real policy terms. I mean, that is worth bearing in mind, particularly as we tick towards November and some of the rhetoric gets ramped up even further, right?
Well, absolutely. And I think we need to understand there's one thing he wants and one thing he can do. And as I said, I think on the foreign policy side, on trade, I think here we need to take him a little bit more serious in that regard, because here he has the power. And I think there's a fair bit of possibility to think about, hey, this could be another source of revenue for the government, which is in dire need of revenues. On the other side, everything a little bit more domestically is a little bit more complicated, also given the fact that we're already running huge fiscal deficits. So I think we need to separate these two factors quite a fair bit. And then the third one is this general different backdrop today versus 2018, 16. Keep in mind, back then, rates were close to zero. We were just beginning to raise rates. He basically, with more support on the fiscal side, he basically added to this fuel of higher rates, and it was completely new, a little bit of a trade war. All these things are known. So I think we should not necessarily take the past, extrapolate it this time around. That's probably ill-guided for making investment decisions.
Yeah, well, speaking of investment decisions then, what about the opportunity commodities-wise? Dominic, I wanted to ask you a little about this, the gold rally, which has been talked about a little bit. I don't want to mischaracterize this, but, delving into the house view, looking at outlooks, there's clearly a range of opportunities, a broad range of opportunities across a broad range of commodities, right?
Oh, absolutely. I think the commodity landscape gives you, at this point in time, interesting portfolio diversification. And I think just starting maybe with that angle first, if you look at the relationship between equities and commodities lately, has been quite low. So there is an added value here to take exposure to commodities. Now, why should they go up? If you look at the latest data, you could argue, well, there's not much in store. I mean, economic data has disappointed. You saw the numbers out of China. They have been on the softer side as well. I think two things we need to consider. Number one, think about what lower rates going to do. Are you going to eat more? No. Are you probably going to travel more? No. But when rates go down sufficiently, you will do more capex spending. Once rates are down 100 basis points and more, that fuels capex, and that historically has been good for commodities. So if you ask me, a broad allocation to commodities, still worth the risk. We're looking at upside, high single digit from a spot perspective. And then as a commodity investor, you also harness the cash collateral, a little bit of roll cost. So net total return, you end up probably returns over 12 months in the low teens. And I think with a volatility of 10 to 15, that's actually not so bad. So broad exposure at this point, highly advised, with the mindset, hey, there comes a manufacturing recovery at some point late this year or early next year, but also thinking about the dollar weakness, which should add, but also La Nina probably is knocking at the door by year end and into next year, which tends to be supportive for agriculture. So I think we do have drivers lined up, which tends to be supportive for a broad engagement. If you want to go a little bit more narrow, I think you talked about gold a fair bit. Rallied a lot. So still a bit more in store. I would say so. We target 2,700. Now, how do you get to 2,700? I think we wanted to signal a big move, and a big move is for us considered, if you look at where we're trading right now, a $300 per ounce. The rationale is very simple. Opportunity cost coming down, given that basically you have a situation where the Fed is able to cut rates, the dollar under pressure. ETF has not yet bought into gold, and I think that's going to be a turnaround factor. And underlying all this is this very, very strong central bank buying, which I think is an important factor. So you don't need that much for markets to push gold higher. So it's still a good story to look at in any pullback like we have today, worth chasing.
Yeah, interesting, especially on that gold picture, Dominic. What about the other commodities? We mentioned the breadth of opportunity. Maybe just mention one or two other standouts.
Well, I think what is interesting when you look at oil, for example, now it hasn't done really much, but I think there's still room to head towards 87, maybe even $90 per barrel. And it's not just a spot move, but you look at the curve in crude, which is downward sloped. So if nothing happens, you already get this roll gains of mid to high single digit. Now, if you add there the cash collateral, that adds another 5% to performance, a little bit on the spot side, and suddenly you have returns in the mid-teens. And I think that's something interesting to look at. A lot of confidence in that OPEC basically continue to make sure this market is not oversupplied and keeping price well bid. That's one thing. Last point maybe to think about is, and that also ties into some of the rationale I mentioned prior, the manufacturing recovery, copper. Now, it's not just a cyclical play. I think that's important. But if you believe we're going to go somewhere in terms of away from fossil fuel, we want to be carbon neutral, it does not going to go without copper. And I think if I look at supply availability, still challenged, the strong secular demand backdrop, we're looking at $11,000, even up to $12,000 a ton. So for those with the right risk appetite, the pullback in copper is something worth looking at for a more longer-term investment horizon of 12 months.
Dominic Schnider. And lastly, on today's edition, let's check in with Nadia Lovell, UBS Senior US Equity Strategist. Nadia, welcome to the show. Nadia, we've had Kiran Ganesh set the big picture, give us a couple of US election scenarios. Obviously, when it comes to sort of decision time in H2 2024, that specific decision, the one made by the US public, maybe looms largest. But as he also explained to us, lots of other things to make choices about, particularly for canny investors. And one is looking at equities, of course, looking at sectors, thinking about diversification as always. But if we just give us a couple of headlines on the equity space as we look into the second half. Still lots of opportunities, still lots to be excited about. Although, maybe we've seen some recent weaknesses. Just give us your headlines on the space at the moment.
Yes, we did have a very strong first half of the year. We had an S&P 500 that was up over 14%. And we know a lot of that was very narrow and concentrated in performance. We had the Max 7 that accounted for much of that. But so far, what we're seeing in the second half is a broadening out of the rally. So you're seeing the cyclical and rate-sensitive sectors. They're starting to perform better. And that's partly due to the rates market repricing expectations for fund cuts sooner rather than later. And for more, the market is now pricing in about 65 basis points or so of cuts. Before that, they were pricing in about 50 basis points before we got those cooler CPI readings earlier this month. And our expectation is for 100% probability of cuts starting in September. So that's helping a relief rally in those areas of the market. And so we're seeing some churning under the hood into a rotation in some of the year-to-date laggers. Now, the question is, how long can this last? I would say we do expect the performance to continue to broaden out. Earnings for the S&P 493 looks to start to be inflecting higher in the second half, but we don't expect the magnitude and the velocity and the performance that we've seen so far this month to be sustained. I think what we would look for is more gradual and a lot of the performance is going to be contingent on these companies' ability to grow earnings. More broadly, I would say we continue to see an improvement in the outlook for some of the largest companies in the S&P 500. And so that prompted us to lift our expectations for 2025 EPS growth, which then therefore prompted us to lift our price target for year-end 2024. So we're looking for roughly 6% upside for current levels, predicated on the fact that we see better earnings growth in 2025. So nothing heroic, but we think it's pretty supportive given the fact that you could see double-digit earnings growth this year. You could see a Fed that's cut in starting in September, and that should help further support corporate investment and stimulate the economy.
Yeah, and let's talk about, in a bit more detail, specifically about AI, because it's such an exciting area. And, you and your colleagues have spoken to us on this program before about the vast potential. And there is, of course, this ongoing expectation that this is going to be a key driver of returns if we're looking at equities over months, but over years, of course. Tell me a little bit more about how investors can best position themselves to really seize the AI opportunity as you see it.
I think that's a great question. I think that there is an opportunity, particularly, given of late that we see some weakness among the tech stocks, particularly semiconductor stocks that have come under pressure of late. And so we've been advising really taking opportunities in that. We're seeing some pressure due to just a rotation out of cyclical growth and secular growth and into cyclicals. And then also that's been a benefit of small cap. We've also seen some headwinds to tech in recent days due to the negative rhetoric that we're hearing on the campaign trail surrounding tech. And so the pullback that we're seeing, we think that it's overdone. And so what we'd be looking to do is really add to the AI enabling layer. So that's the semiconductor names, but we would also tactically be looking to broaden out that exposure to some of the intelligence layer as well as the application layer. So that includes internet names and software names. Ultimately, we think that by the time you get to 2027, that this could be an over $1 trillion revenue opportunities across that value creation stack. If we see a pickup in political rhetoric, we would use that as a buying opportunity.
Nadia, let's talk about November's presidential election. When it comes to what this means for investors shouldn't be looking to pivot too much depending on what they imagine an outcome might be, and still quite a lot of uncertainty despite, Trump maybe tracking a bit more positively at the moment. But what about changes that could result because of differences in policy terms? And in particular, I'm thinking about tariffs, of course, Nadia. How, I don't know, what kind of impact do we expect? Let's say it is a Trump win in November. How should investors be thinking about the impact down the track from tariffs? Because that looks like a key area, certainly if we see, if not a kind of, a landslide for GOP across all of the institutions, but certainly even with a Trump win, it looks like that will be the direction of travel.
Yeah, I think the way you started that question is a great way. We continue to say that we don't advise investors to really make any major changes to their strategic portfolio allocation based on expected election outcome or political preferences. No matter who, there's likely going to be increased U.S. protectionism, and it's just the degree that will matter. In the case of, former President Trump, there is the likelihood that he'll push more substantial tariffs, and that has implications for inflation and U.S. multinationals. The higher tariffs could favor U.S. domestic manufacturing companies. So think about areas like steel, aluminum, lumber, solar cells, auto companies could benefit. But it could also be at the same time a headwind to those that have supply chains abroad. And the companies that tend to have that could be most impacted tends to be consumer discretionary goods and also some industrial companies. And then we have to be mindful that, there could be risks to U.S. multinationals from retaliatory tariffs from foreign governments. So that's something that we'll be watching as well in terms of the potential impact for tariffs. But it remains to be seen. A lot is said on the campaign trail. We know former President Trump has been talking about a 10% across-the-board tariff, 60% on China. It feels like that's a starting point for negotiation. But as I said, a lot is said on the trail. It doesn't always turn into policy.
A final thought, Nadia, perhaps regarding the longer-term view for investors?
I think it's important that we think that, investors should stay long the market and move some cash off the sidelines. We think that equity returns will continue to outperform cash, but what's really important is to maintain that focus on quality, putting that money to work in quality names. So we're talking about profitable companies with strong balance sheets and good free cash flow generation.
Nadia Lovell, bringing us to the end of this edition of the Bulletin with UBS. You can listen again and explore more at monocle.com or follow the programme wherever you get your podcasts. As ever, you can discover more and find out how UBS can help you at ubs.com. This is the Bulletin with UBS on Monocle Radio. I'm Tom Edwards. Thanks for listening.